Every time you bring in a new strategy, you quietly reset your trading skills back to the beginning, whether you realize it or not. Take that breakout pattern, for example. Maybe you've worked with it 80 times already. By now, your instincts are getting sharper. The early confusion is gone, and you can almost feel which setups are about to take off and which ones will stall. But then, you introduce something new, like order blocks. Suddenly, all that hard-earned experience slips away. No more accumulated practice, no instant recognition your trading edge is gone. You might believe you're unlocking new possibilities, but in reality, you're undermining the very advantage you fought to build. Every legendary trader you've heard about, they became great by mastering just one setup. Take Ed Seykota, for example. Over his incredible career, he turned $5,000 into $15 million, and he did it with a single method: trend-following breakout trades. When the markets went quiet, he stepped aside. He didn't chase reversals, he ignored consolidations, and he never dabbled in mean reversion. He waited, sometimes for months. One setup. Relentless commitment. That's how fortunes are made. Here's a secret that most people overlook. While many retail traders jump from one strategy to the next, cycling through several setups in just a week, they still can't figure out why they keep losing. So what's really draining your trading account? It's the belief that adding more setups will give you more chances to win. But the truth is, it does the opposite. Adding more setups only creates more confusion, makes it harder to recognize real patterns, and stops you from building true expertise. When you spread your efforts across multiple strategies, three core problems begin to show up. Once you see these patterns clearly, it's easy to understand why every market legend focused on just one or two and reached greatness. The first reason is the lack of what you might call a grandmaster's intuition. Think about chess grandmasters. With just a quick glance, they can remember an entire board. But if the pieces are arranged randomly, that advantage disappears. Their strength isn't memorizing every possible move. It's having a deep practice familiarity with real patterns they've seen in thousands of games. Trading works the same way. This is what sets true expertise apart from simple recall. Trading works the same way. When you dedicate your focus to just one pattern, you start building your own mental catalog just like grandmasters do. See a bull flag a few hundred times, and your brain no longer has to analyze every detail. Recognition becomes instant. You immediately sense if it's a textbook formation or a subtle fake-out. You spot the exact volume clues that signal a true surge. Almost subconsciously, you start to notice which setups are likely to collapse and understand why. This isn't about calculated step-by-step thinking. It's the natural result of consistent exposure, real pattern recognition, developed through repetition. But if you're always juggling 10 setups at once, you only get a fraction of experience with each. Maybe you spot 20 bull flags, 20 head and shoulders, or 20 order blocks. But that isn't enough exposure to master any of them. A couple dozen attempts just isn't enough. It barely gets your feet wet. And so you end up stuck in that exhausting mental grind, where every single trade feels like a test. Doubt starts to creep in. You begin questioning every decision. Is this really the pattern? Should I pull the trigger? What if this is a false signal? Without experience, you never develop that deep instinctive competence. You never just know. In trading, if you're still struggling with a decision, you're already falling behind. Think about traders who follow ICT inner circle trader methods. They focus intensely on order blocks. These are points on the chart where major players, or what's known as smart money, have caused big imbalances by entering or exiting large positions. At first glance, it all seems so simple. Yet a trader who has spent 2 dedicated years sharpening their focus on order blocks can see nuances that most people wouldn't even notice. That trader instinctively senses when an order block will hold strong and when it's about to break. They can tell right away if a sudden move into an order block is a clever trap or a genuine test of support. Each candlestick shape and the volume behind it tell a story one they're able to read at a glance. They know if institutional interest still lingers or if it's moved on. For them, making these decisions takes only seconds because they've faced this exact scenario hundreds of times before. Meanwhile, you might find yourself juggling order blocks, chasing breakouts, trying to time reversals, and piling on countless other setups. Your attention gets split and progress stalls. Maybe you've come across order blocks dozens of times, yet you keep analyzing each one, second-guessing yourself, hesitating. Here's the truth: that specialized ICT trader isn't any smarter than you. The real difference: they chose to dig deep into one strategy instead of skimming the surface of many. If you stay shallow, you'll always remain ordinary, never standing out in any single approach. But going deep and becoming a true specialist is what sets you apart. In trading, being a master of one is worth far more than being mediocre at many. Next comes the challenge of decision paralysis. Here's what's really going on in your mind when you try to juggle every setup on your list. Picture this: it's 10:47 in the morning. Suddenly, a stock you've been tracking surges, breaking above resistance with strong volume, a textbook breakout opportunity. But at the same moment, you notice a bearish divergence flashing on your RSI, hinting that a reversal might be near. And just then, the price touches the daily moving average, signaling a possible rejection. All of this happens at once, pulling your focus in different directions. Now, you're looking at three patterns, each pointing in a different direction. Which one do you trust? Minutes pass as you analyze, debate, and find yourself stuck in a cycle of indecision. By the time you finally make your move, the breakout has already shot ahead by 5%. Now, you're scrambling to catch up. Or maybe you go for the reversal play, only to get stopped out almost immediately as the breakout keeps charging forward. This isn't really trading. It's hesitation and second-guessing, just disguised as a strategy. Think about Tudor Jones. Back in 1987, he achieved an incredible 200% return, even as the market suffered a historic single-day crash of 22%. So, what was his secret? Jones focused on one key setup, spotting when a trend was losing momentum and preparing for a reversal. That was his edge. When the chaos of October 1987 hit and signals became overwhelming, Jones was never confused. He recognized his signature setup, one he had seen many times before, just on a smaller scale. There was no hesitation, no second guessing. He acted. While other traders were caught in a web of conflicting strategies, Jones was already ahead, prepared for the next move down. One pattern: total focus, not a moment of hesitation. Trading with multiple setups doesn't make you more versatile. It creates inner conflict, the kind that slows your reactions and clouds your judgment. Suddenly, each chart you see turns into a mental tug-of-war. The breakout strategy urges you to buy. Your mean reversion plan, though, tells you to wait. And momentum theory, it warns that the move has gone too far. Now, instead of reading the market, you're battling with your own competing voices, unsure which one you should trust. This internal struggle creates an even bigger problem: inconsistency. When you keep switching strategies, your trading process is never the same. One day, you're trading a bull flag breakout. You know this setup well, your confidence is high, and the trade goes as planned, double your risk, profit booked. But next, you jump into an order block retest. Everything feels different: the setup, your entry points, your stop placement, even how you plan to take profits. You've only tried this setup a handful of times, maybe 3 dozen at most, so you feel uneasy. As a result, you enter the trade with a smaller position size. You tighten your stop loss more than usual. As soon as the trade stalls, you exit early, chasing the memory of that strong bull flag move. The outcome? You close the trade too soon, taking just a small profit when you could have doubled it. This leaves you feeling like order blocks are weaker than bull flags. But really, it isn't the pattern that failed. It's your decision-making that cut the trade short. Now, let's say the same order block setup hits your stop loss. It's a small loss, seems manageable at first, but deep down you feel uneasy. Frustration starts to seep into your mindset. The next time a Fibonacci bounce shows up, you find yourself off balance and full of doubt. Maybe you hesitate and miss the chance, or, in your desperation to recover, you jump in too aggressively. Either way, you've stopped trading your strategy. Now, you're just trading your emotions. This is the hidden cost of juggling too many playbooks. You lose the stability and self-control that come only from practicing the same routine again and again. Now, imagine a trader who commits to mastering just one setup. Every trade feels familiar. The process is the same: entries, stops, targets, even the way the market looks and feels. That repetition, that's the secret. It builds unbreakable discipline. After placing that same trade 100 times, execution becomes second nature. The emotions fade. You've already watched this play unfold again and again. Wins and losses don't shake you anymore. Now it's all about probabilities. Every time you take your standard position size, trusting in the pattern. You stick to your planned target, confident in how the setup develops. And if your stop is hit, you accept it because you know that resisting the loss only leads to bigger mistakes. That's what true consistency looks like. It's this unwavering discipline and execution that sets profitable traders apart. Take Ed Seykota, for example. He turned a modest $5,000 into an incredible $15 million by focusing on just one method: trend-following breakouts. People were always pitching Ed new ideas. Check this out, Ed, this stock is oversold. Massive rebound coming. But he ignored them. That wasn't his playbook. Ed, here's a classic mean reversion setup. There's money on the table. Again, he passed unmoved. Ed let thousands of tempting trades slip by, simply because they didn't fit his chosen pattern. That kind of steadfast discipline, the unwavering repetition of just one method, was the driving force behind Ed's extraordinary growth. When your entire process revolves around a single setup, emotion fades into the background. There's no inner debate about whether to take the shot. You either see your pattern or you don't. Position size, it's always the same. Stop loss, it never changes. Taking profits, you stick to your exact target every single time. This is the essence of true mastery. You can't reach it if you're always jumping from one strategy to another. Remember these words from Bruce Lee: "I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times." Trading is much the same. If you have a couple dozen setups, you're like the person who's tried 10,000 different kicks just once spread too thin, never truly mastering any of them. But if you've drilled one setup 500 times, you've honed the focus and precision that comes from mastering a single skill. That's the type of trader others should watch out for. When you reach this level of deep familiarity with your pattern, it's almost as if the market starts opening secret doors just for you. Subtle details begin to stand out. Maybe you notice your usual setup works best with light volume during consolidation. It wins 80% of the time. But with high volume in those same situations, your success rate drops to just 40%. Perhaps you discover your edge is sharpest in the first 90 minutes after the opening bell, but fades as the session goes on. Or you might spot more false signals when the broader market moves sideways, while a solid trend makes your strategy operate almost perfectly. These insights aren't taken from trading manuals, they come from your own careful observation. These are lessons forged through repetition, by seeing the same patterns play out again and again in every kind of market, whether wild or calm, whether sectors are shifting or macro trends are changing. The core lessons remain the same. A trader who juggles 20 different strategies never gains this kind of deep understanding. They stay stuck in the middle, well-informed, but never truly exceptional. And in trading, being intermediate leads nowhere. The market doesn't reward knowledge alone. You don't get paid just for understanding strategies. The real advantage comes from executing one approach better than anyone else. Let's see how this plays out in today's trading world. ICT, short for Inner Circle Trader, has captured the imagination of thousands. Concepts like order blocks, fair value gaps, and liquidity sweeps are everywhere. But there's a clear line between traders who struggle and those who consistently pull in profits. The real winners drill deep into just one concept, mastering every detail. Take the order block specialist, for example. An order block marks the point where big institutional players make their moves, leaving a footprint, a price zone that often pulls the market back for a retest. It sounds simple enough. However, the typical ICT enthusiast often makes a crucial mistake. They try to juggle everything at once: order blocks, fair value gaps, breaker blocks, liquidity sweeps, and optimal entries. But each of these signals only appears a few times each month, so their experience is scattered, and they never really master any one thing. Those who try to learn everything at once stay stuck at the surface. But the order block specialist does things differently. They're laser-focused, trading only order blocks. This focus means they see the same pattern about 20 times every month, building real skill through sheer repetition. After 6 months, they've completed 120 trades, every single one following the same method. This repetition leads to deeper insight. They learn that order blocks created by heavy and fast institutional buying are usually much stronger than those that form quietly during low-volume periods. They also notice that the first time price revisits an order block, the odds are usually best. A second retest is less reliable, and by the third time, the setup almost never works. Over time, experience reveals another advantage: order blocks that sit just beneath a liquidity sweep, where retail traders get caught out by a false move, tend to significantly boost win rates. Here's what's happening: institutional money has already gathered the liquidity it wanted. They also understand that order blocks, which line up with larger trends or appear on higher time frames, consistently outperform those that are isolated on shorter time frames. These professionals are skilled at spotting the subtle signs of a failing order block. For instance, if a candle wicks straight through the zone with strong volume, if the area is tested repeatedly before making an entry, or if the setup goes against the higher time frame trend, these are all warning signals, and you won't find this level of insight in free ICT tutorials online. This level of understanding comes only from putting in the work. Imagine 120 focused reps with a logbook documenting every outcome, wins, losses, and break-evens. You take the time to analyze, to connect the dots, and learn what truly matters. Now picture a trader trying to master every ICT concept at once. They also log 120 trades in that same span. But instead of depth, their trades are scattered 20 each in order blocks, fair value gaps, breaker blocks, liquidity sweeps, optimal entries, and anything else that pops up. They remain a beginner in several areas at the same time. But the specialist, they march steadily toward real expertise. When an order block opportunity appears, they don't hesitate. Their fingers on the trigger in less than 30 seconds. There's no room for doubt because they've seen this situation unfold more than 100 times. They know their advantage, and when it's time, they take action. While the generalist hesitates, they're still weighing options, still looking for another sign, still unsure if this is the right order block. The specialist is already in the trade, guiding it toward profit. That's what mastery really unlocks. It's not about finding a magic strategy, it's about perfecting your execution of the same strategy. Before we get into the topic of opportunity, there's an important point about trading edges that needs to be addressed. Trading edges aren't as strong or reliable as many people think. In fact, they're surprisingly fragile. An edge isn't a rule set in stone that works every time. It's just a slight statistical advantage that only shows up under very specific conditions. Take the classic bull flag breakout, for example. This setup can work well in a trending market, especially when volatility is increasing. But use that exact same pattern in a choppy sideways market, and your edge quickly disappears. It's the same tactic, but in a different context, so there's no advantage. This is where many traders make mistakes. An edge is created exactly where two forces come together, the current market regime and the volatility landscape. If either one changes, your advantage can disappear instantly. Let's start with the market regime. This sets the overall mood. Are stocks rising together, or are they moving sideways? Are investors taking more risks, or holding back? Is the market in a phase where people are accumulating shares, or quietly distributing them? Take a breakout strategy, for example. It might deliver steady gains during a strong uptrend, but if the market shifts into a slow, sideways period, that same strategy can quickly turn into a money loser. The setup on your chart hasn't changed, same triggers, same stops, but change the regime and your trading edge can disappear without warning. No one understood this tension better than Tudor Jones. His best trend exhaustion trades weren't just luck, they worked because he had a sixth sense for reading the environment. When the market surged strongly in one direction, then started to lose steam, he recognized his moment. That's when his edge came alive. But if you try to use those same reversal patterns in a slow, indecisive market, you're left with nothing but frustration and failed trades. Tudor Jones understood a crucial principle: he never forced his strategies into situations where they didn't belong. Instead, he waited patiently for the right environment, and when that moment came, he moved decisively. If conditions weren't right, he simply stayed out of the market. Most traders, however, make a different choice. They see their favorite setup and take action, no matter what's happening, whether the market is trending, stuck in a range, swinging sharply, or going nowhere. The outcome? They get confused when a strategy that made steady profits just last week suddenly starts bringing in losses. The core approach remains unchanged, but beneath the surface, the market regime has shifted, and it's taken away their edge. Now, let's talk about volatility. This variable influences everything. Volatility can rise or fall. It can run hot or barely move at all. Certain trades only work when there's plenty of price action. Breakouts, for instance, need expanding ranges to build momentum. But if you try to catch those setups when volatility is drying up and price stays stuck in a narrow range, you'll get whipsawed out of the trade again and again. Moves stall out, stops get hit, and the breakout fails before it ever gets going. On the other hand, mean reversion traders thrive in low volatility markets where prices move within tight channels. In these calm conditions, price slowly drifts away from its average, only to snap back, creating what can feel like easy profits. But everything changes when volatility returns. Suddenly, those reliable mean reversion setups don't work. Instead of snapping back, the price just keeps moving in one direction. What looked like a textbook oversold signal quickly turns into a free fall, leaving traders with no chance to recover. Ed Seykota found his edge by understanding a simple truth. His system worked best in high volatility, strongly trending markets. When things slowed down and volatility faded, he stepped aside. He never tried to force his trend-following strategy during quiet, sideways periods. Instead, he waited sometimes for weeks or even longer until the right conditions came back. Here's the reality: your trading edge isn't always there. It only shows up in those specific and sometimes rare situations. The rest of the time, it might not be there at all. When you're juggling 10 different setups, it's nearly impossible to keep track of each one's specific rules and volatility needs. Maybe you start your day trading breakout strategies as volatility rises. Then, as the market dynamics shift by afternoon, you switch to reversal plays. Later at night, when things calm down, you try range-bound tactics. Each approach needs its own set of conditions to truly work in your favor. But if you aren't tracking these crucial details, you're just reacting to patterns instead of acting on real opportunities. That's not strategic trading. That's relying on luck, just hoping the market will move in your favor. But a trader who concentrates on a single setup knows the landscape inside and out. They can spot their edge the moment it appears, and just as importantly, recognize when it's gone. Take the bull flag trade, for example. This strategy only works in a strong uptrend when volatility is high. If the market shifts into a sideways pattern and volatility drops, they step back. Focused traders can sense these regime shifts as they happen. Their awareness is sharp and intentional. Some traders have a sharp instinct for sensing when market volatility is about to disappear. They know when to step aside and protect their hard-earned profits. These traders don't just look for patterns, they understand the bigger picture. Their real strength is putting setups into the right context. This is what takes a simple chart pattern and turns it into a winning strategy. Without context, a setup is no better than flipping a coin. Take William O'Neill, for example. He became famous for trading cup and handle formations, but that's only part of his story. He focused on patterns forming in the strongest stocks, within leading sectors, during solid uptrends, especially when volatility pushed the move even further. If just one of these key factors was missing, no uptrend, weak volatility, or lagging sectors, he simply stayed out. O'Neill knew his edge was only present when all these conditions came together, so he had the discipline to wait, sometimes for long periods, until everything lined up. When it did, he moved forward with real confidence. When it didn't, he made protecting his capital his top priority. You can't achieve this level of precision if your attention is scattered across several different setups. You never really learn the conditions that make any one strategy work. Instead, you find yourself trading every setup in every possible market environment. Then you wonder why your win rate sits at 50% instead of the 70% you hoped for. The reason is painfully obvious: when you stray outside the conditions that give you an edge, half your trades are doomed before you even start. Breakout strategies fall flat in choppy sideways markets. Mean reversion bets get crushed when volatility explodes. You're constantly at odds with the bigger picture, mainly because you don't actually know what the bigger picture is. Now think about a trader who's focused on a single approach. There's no confusion there. They know exactly what environment their edge needs, and if those conditions aren't present, they simply stay on the sidelines. That's how they're able to consistently pull profits while others continue to struggle. Here's the hard truth: believing that more setups mean more opportunities is just an illusion, a trap that can drain your trading account. The reality is, when you spread yourself too thin, you never develop the deep intuition needed to recognize when your edge truly appears. The one setup trader develops an almost instinctive sense for the right market climate. They know when to stay quiet as the odds turn against them, and when to spring into action as everything falls into place. But if you're juggling 10 different setups, you'll always find a reason to trade, even when the best move is to wait. When the market feels unpredictable and choppy, range trades start to look appealing. And when momentum picks up, breakout trades seem like the obvious choice. When trading volume is thin, you might lean toward mean reversion. But when the action heats up, momentum plays suddenly call your name. Before you know it, you've built a way to trade in every possible scenario. There's always a chart lighting up, always a reason to open a position. Before you know it, you're constantly in the market. And that's exactly where the trap lies. The most successful traders like Jesse Livermore, Ed Seykota, and Tudor Jones spent most of their time simply watching and waiting. Their patience was legendary. They acted only when their specific setup matched their perfect conditions. When everything aligned, they moved boldly. But when it didn't, they were completely comfortable just watching from the sidelines. If you're trying to juggle too many setups, that kind of discipline becomes almost impossible. Something always seems to catch your eye, tempting you into unnecessary trades. It can feel like you're creating more opportunity, but in reality, you're just getting pulled into distractions. Even Mark Minervini, a multiple-time U.S. investing champion, understands this well. He focuses solely on one specific approach, late-stage bases in top-performing stocks, stocks that show unwavering strength. Every week, he ignores a flood of opportunities that don't fit into this narrow window. He's willing to let countless trades slip by because his goal isn't to chase every possibility. It's about staying disciplined and true to his strategy. He's only looking for situations that match his edge, those rare moments when the odds truly favor him. It's that unwavering discipline, that willingness to say no to everything else, that separates champions from the crowd. You can't build that kind of self-control when your focus is spread across too many strategies. Instead of waiting with purpose, you end up always chasing, trapped in a cycle of reacting to everything around you. If you've ever read Jack Schwager's Market Wizards series, you might have noticed an interesting pattern. Every trader he interviews has their own unique approach. Some focus on breakouts, others look for reversals, some dive into fundamentals, while others use pure technical analysis. The variety is truly remarkable, but there's one thing they all have in common. Each of these top traders sticks to one core strategy, and they execute it with almost religious consistency. None of them are dabblers. You won't find these market legends spreading their capital across a dozen strategies they haven't fully mastered. Each trader found their signature move, then dove deep until they understood every nuance. Richard Dennis dominated with breakouts, amassing a fortune worth hundreds of millions. William O'Neill focused on cup and handle bases and turned that strategy into great wealth and an empire. Paul Tudor Jones earned his reputation hunting trend reversals at the point of exhaustion. Ed Seykota stuck to trend-following breakouts, growing $5,000 into $15 million. The common thread is clear once you see it. True greatness comes from depth, not breadth. Mastery always outpaces variety. Specialization beats spreading yourself thin. Still, most traders move in the opposite direction. They keep adding new setups, thinking that more tools will magically improve their results. But in reality, extra tools just slow you down like carrying too much baggage in a race. It's easy to understand why people resist this advice. Committing to a narrow focus can feel confining, almost like you're missing out on that one big trade. And yes, the truth is you will miss plenty. Jesse Livermore missed trades all the time, but it never stopped him from making history. Ed Seykota missed trades every single day. Paul Tudor Jones did too. Even Mark Minervini lets trades go by constantly. But elite traders pass on most trades intentionally. They simply refuse to act until their ideal setup appears, the one they know inside and out, where their odds are the best. And when those exact conditions finally line up, there's no hesitation or doubt. They dive in with conviction and size, fueled by confidence built through endless practice. That's the reality of elite trading. You'll skip far more trades than you take, and you'll be better off for it. The choice is clear. You can either keep spreading your attention thin, trading a mix of setups you barely understand, or you can wait, focus, and act only when the odds are truly in your favor. Or you can choose to dive deep into one strategy, working like a true professional. This isn't just about what you know, it's about how well you put that knowledge into action. Achieving consistent excellence is impossible if you're always switching approaches, filled with uncertainty and second-guessing yourself. Pick your setup, commit to at least 100 repetitions, gather data, and refine your edge. When you do, you'll find that everything else starts to fall into place. Here's a truth rarely spoken in trading circles. There are countless ways to profit in the markets, thousands of strategies that anyone could use. In the end, you'll only succeed with the approach you commit to completely. The winning formula isn't flashy, it's simple. Find your competitive edge, practice it until it feels natural, and act with relentless discipline. Everything else is just a distraction.